Yeah, thanks for coming,
Thanks
everybody.
for coming, everyone. Yeah.
It's nice to have this turnout.
Yeah.
The weather.
With the weather, and with me very sick 2 weeks ago. So I
Yes,
really,
that's right.
really
I
hit it.
almost didn't come today.
Amal, when we started discussing this in the fall, Amal's like, okay, but what if I get sick? And I was like, you're not gonna get sick, it's gonna be fine.
Such an accountant question.
Right? Like she was like, but what happens when I get sick? It's January. And then the day before, she's like, you're not looking very good. And I was like, I'll be fine. And then Wednesday when I had to cancel. So
Yeah.
I got sick.
Well, that night you were pretty sure that a night of rest was going to do it.
Yeah, I was very,
She's like,
12
"I'm gonna
hours
go
of sleep,
home,
I
I'm
will
gonna
be fine."
rest, and I'm going to be fine.
truck hit me. It was
So,
bad.
yeah.
So welcome. I think we both know everyone. My name's Julie,
Yeah.
if you don't. Senior Wealth Advisor with Wellington Altus is what I have to say. You want to introduce yourself?
Yeah, I'm Amal, so I'm a CPA, been in public practice for a long time.
Oh, you're not going to say the years? Oh.
Okay, like over 20 years. So I've been working with small business owners, and yeah, that's a little bit about me. Tax, accounting. We have a small team of 5, and Julie and I have been working together for a few years now.
Yeah, a few years.
We like each other.
Yeah, we go back and
going-
forth with some
it's going
clientele.
good.
We have very complementary services.
Mm-hmm.
So I'm in the investments and the insurance business, as most of you know.
Yeah.
And I know enough tax to get dangerous. Like, I can't answer that question. You need to speak to Amal. That's about as much
yeah,
tax.
Sometimes you like to push the boundaries, and I have to set the limits.
I'm
Good
really
guy,
in a dark
bad
gray
guy.
zone. I really like dark gray, and Amal really likes black and white. So
Or so you've been told.
so I've been told. Yeah, exactly. So we have a couple things that we're going to run through tonight, things that clients ask us constantly. Happy to talk about relevant stuff in the media. Yes, I can touch on tariffs. I can talk about the impact, what we think will happen, all the good things. But I think we're going to start with a bit of an agenda that we put together. We can answer questions throughout, at the end, really
Yeah.
whatever everyone's comfortable with. It doesn't
Yeah,
phase
I think it's a
us.
small group, so feel free to interject and ask
Yeah.
questions.
Yeah,
Yeah.
feels good by us. Okay,
Okay.
awesome. You get to start.
Take it away.
You
Okay.
get to start.
So first thing we were going to chat about a little bit was the time of year, and given the time of year it is, we get into personal tax planning, corporate for some of you guys that are small business owners. I think we have a good mix in the room, so I'll go over a little bit that is relevant to each type of taxpayer that we're going to have. So first thing that we're going to get into is a little bit about personal tax and the common questions that I see at this time of year. So big one that we all do every year, but because we do it once a year, I think by the time you get to it, you're like, what do I do? How do I get started? What happens at this time of year? So the one thing that I would start with is the big question I get is personal tax and what do I do? What do I need to give you? What can I tax deduct? Those kind of things. So everyone probably has some good experience with that, so we'll just go kind of high level, and if anyone has any questions, just jump in. So some of the things that you're going to be passing on to your accountant are any like T-slips that you get. So if you're employed, you have T4s, investments, you're going to get like T5s or T3s, just depending on the type of investment that you hold. And then that is income sources. Other income sources that you might have would be rental income, some things that you may not be aware of that you have. This is something that I get all the time is you have a house, you got married or you got moved in with a roommate or whatever the case may be, moved into a different property, and now you're renting your house. So this is something that you need to communicate with your accountant because although it may not be taxable, it's a tax implication. There's tax implications and it's reportable at the time. So that's one of the things I would caution you to just be aware of and communicate on those things. And the other thing I would look at is tax deductions. Those are, I think, main sources of income, rental, property, and then if you're self-employed as well, you need to have those summaries of income that you have from your self-employment. And then we go to a deduction. So you have several different types of deductions. I'll just hit the most common ones, right? We've got RSPs, which if you're working with Julie, I'm going to reach out to her and bother Tori for that kind of stuff. So you have RSPs, if you've made any of those. TFSAs, that is not relevant to your tax. So we really don't need to know that at tax time. And other types of common expenses we see as medical expenses. If you are self-employed, you can tax deduct anything that a regular business owner would tax deduct. So, professional fees, advertising, if you're paying an assistant. We'll get into auto expenses later because that's one of the number
We'll
one
get into all the
questions that I
write-offs
get.
you
We're
can
gonna get
do,
into all of
according to
that.
me and according to Amal.
Yeah, so you have your income, your tax deductions, and then your reportable events. If you have any investments that are outside of maybe an RSP or TFSA, so those are what we consider non-registered investments, those are the things that we need usually to coordinate with your advisor on. So usually we can just get reports from them. They help us to know what are your income or expenses for the year from that.
Yeah.
And those are the basics for personal tax filing. Any questions on that? No? You have no clue. She's like, sometimes you have an accountant that might just do it all for you. She'll just reach out and remind you. But if you don't, you guys have to kind of figure that out on your own, right? So that was my one bucket. My second bucket that I want to talk about is paying tax and installments. So this time of year,
Should you pay them?
you should pay
You
your
should pay
taxes.
them, yeah.
You should
Okay.
pay them, and you should try to pay them on time. You should try to pay them on time. If you try to take them out of your investment account, your advisor might not be happy with that.
We don't love it. Happens though.
It does happen. So this time of year, we're looking at two different things, right? We're looking at what happened last year and what might I owe from last year. Or if you're lucky, you're going to get a refund. And I like to encourage people to put it in their RSP. Just like creates this like balloon in the right direction. But so you're either going to have your tax payable from last year or your tax refund. Okay. So if you have a tax refund, you're going to plan, okay, what am I going to do with this for the coming year? How do I need to use this money? Can it also help my tax situation for next year? And then there's the tax owing. So if you've planned for this over the past year, you're going to be in a good position to maybe pay your taxes on time. If not, we can chat about that separately. But so you have your tax owing, tax deadlines if you're a T4 employee or T5. So if you're not self-employed, and by self-employed, I don't mean through a corporation. I mean you're running a business and you don't have a corporation. You're just reporting everything on your personal tax return. So those due dates are a little bit later. It's June 15th to file your tax. But wait.
She got them to all do it by
It's
April.
April
Amal.
30th to pay. So taxes are usually paid by April 30th. So that's another point of planning that you would start looking at right now before you get into that. And then the other big thing that sometimes people aren't expecting is they may owe installments for the coming year. So if you have a big tax owing last year and you expect to have a similar tax owing next year, the CRA doesn't really want to wait to get their money because a T4 employee has tax deductions taken off source at the time. So what they say is you have to pay us throughout the year. And it's not a recommendation, it's a requirement. So failure to pay those installments, what you get into is installment interest and installment penalties. So the thing I see people run into at this time of year is, okay, they have this big bill from last year, and then they have installments, more common in like the first years, and then they have installments to pay for next year. So you start getting into cash flow issues, which is where we kind of want to dip into your account.
Yeah.
Sometimes.
Where Julie gets a call. Yep.
This is where she gets a call. So that's my second bucket, is just being aware of cash flow from taxes arising from previous year, and then installments for the second year. Okay? Everyone's good? All right. So my third bucket is more directed for business owners and just the planning that they have to go through at this time of year, because as business owners, you have different options in how you want to pay yourself. If you have a corporation, there's two more common ways that you take out money. It's either through a salary. We have a yawn. Is it getting worried? You're good. Okay. It's through salary or dividends. Okay, so we've got those two different types of ways to pay ourselves. So something that would tie into, a little bit on the investment side is when we have salaries, that's considered earned income. So when you have earned income, this generates RSP room for you. you can tax deduct more things against that. So RSP, your deductions start to be of more value.
Yeah, they're
when
more
you have earned
yeah.
income. And we have dividends. So although you are earning the income because you're self-employed and you're working it, it's characterized differently when you take it out of your corporation as a dividend. And that difference is, so the bank doesn't consider it as stable. So let's say you're going to apply for financing and you need a mortgage. They usually don't look at dividend as strongly as they would look at a salary. So this is something to consider when, if there are events in your life that might trigger the fact that you might need a salary, for example. So at this time of year, what I encourage business owners to do is just consider what do you have coming up in the coming year that might warrant a change in maybe your remuneration planning. So if you've been on dividends and you think, I have a child that I'm going to hire a nanny and I'm going to have high childcare expenses. So these are things that you would need to move on to salary for to be able to tax deduct those things. Or if you know that, okay, this year I think I'm going to be getting a mortgage, for example, I might need to have a base salary and then take out my dividends. These are things that you want to start to look at and plan for ahead of time. And then this also integrates into long-term planning. I think, if in the long term you think, I want to invest in my RSPs, my retirement plan is to stay here in Canada, I don't plan to move anywhere, I want to save in my RSPs. These all tie in somewhat to your remuneration planning and whether you take out salary, dividends, or a combination of the two. So that's the final bucket, is just sitting at this time with your accountant or your advisor and planning what does my year look like? What do I think I'm going to need this year in terms of income? This also ties into cash flow actually too, because depending on the business, sometimes you need a combination of the two, of a salary, like a base salary, and then dividends to add on to that as you have the cash flow in your business to do. So those are kind of my 3 buckets that I wanted to touch on the planning section.
The planning side. Good work.
Yeah. Yeah.
Questions?
Questions on that?
Sorry, excuse me, I have a question.
Yeah.
Is the tax rate comparable from a salary perspective versus dividends? Because my understanding is that it's actually gotten very close, so it really doesn't matter.
That's a great question, yeah. So that's another thing I get all the time is what's better, salary or dividends? What's going to save me taxes? The answer is it's really dependent on your personal situation. So like I said, if you might have daycare of $1,000 a month, if you're taking out dividends, then you're losing that tax deduction, right? So it's really depends on the situation. From a just pure tax standpoint, there is pretty close integration. The concept is called integration, and there is a pretty close integration whether you take out salary or dividends. If you look at it as from a bird's eye view, the whole business unit, yes, it's integrated. So the things that I would encourage looking at if you're trying to decide between salary and dividends, one of them would definitely be cash flow from a business standpoint. And from your standpoint, some people are not great at following, a payroll schedule and don't want to have those deductions taken off. Yeah. And that's fine. I think that's where you say, okay, this is how I am, this is who I am, and this is what works for me in my business. In that instance, I think you just get into more of, okay, you need to manage the cash flow then and think that if you take this dividend, I might need to set aside 20% or so because I'm going to have to pay tax on this at the end of the year. There's nothing worse than getting to the end of the year and you have this big surprise bill that you didn't anticipate. So that's one of the things I would encourage is looking at what are your tax deductions. Paying into CPP is another big one. People, don't really think about that, or the statement that I hear all the time is, well, I'm not going to rely on CPP. And that's okay. Mm-hmm. Definitely don't rely on CPP. But
don't rely on it solely. It
exactly.
is apparently actuarially sound if you're born up until 1980.
Yeah.
Anybody born in the 80s? No bueno yet. Not actuarially sound.
Really?
Right.
Apparently. Yeah. Apparently.
Interesting.
But anyone born in the 70s, you are rolling.
So here's my take on it.
Like that's what they announce.
It's like when you look at the whole tax from a tax perspective and you include CPP,
yeah.
you're paying about the same amount.
Yeah.
So you might as well pay it, take the gamble,
Yeah.
right? And even if you move out of the country, CPP follows you.
Yeah, it
And
does.
It's just
You can get it
non-resident tax
anywhere.
on that.
Yeah.
Yeah, so I had a client, they're
Yeah.
moving to Colombia. They bought some properties, and he wants to stop paying it to CPP. So the thing was, I said, well, if you're taking out the money anyways, CPP will follow you. It's
Yeah.
probably worth more there too, so.
Might be.
No,
Yeah,
seriously.
It's fair. It's fair.
Like,
Yeah.
Yeah, so, yeah, good question. Does that answer your question?
What, is it taxed at the same rate roughly? I think that's right.
Oh,
You were saying yes.
tax rates are similar overall,
Okay.
yeah.
Yeah.
So the difference is a salary is a tax deduction in your corporation, and then you get taxed on the same rate when you take that money out, but your corp saves the tax. Whereas when you take the dividend, your corp pays tax, and then you kind of get a credit for that on your personal tax return that's fairly equivalent. So when you look at it at the end of the day, it is a similar tax rate, yeah.
Thank you.
Yeah, you're welcome. Yeah.
I've almost always owned my own business and paid myself that way.
Yeah.
Most recently, mostly through a salary. I'm growing my team this year, and I'm wondering now that I didn't realize actually that sort of paying someone not through a salary, like as a contractor, that they wouldn't be able to deduct things like daycare, etc. Is what you're saying? Like, is that how I'm understanding that?
So when you pay a contractor on their personal tax return, it's still self-employment income. So they still get to deduct childcare. It's when it's dividends, because so when you take out dividends, they're taken out via your ownership of the corporation. So as a shareholder, you're entitled to dividends. So when you take out dividends, that's investment income, and you can't deduct like childcare or the similar healthcare expenses. They are deductible, but to a lesser amount.
Yeah.
So yes, but as a consultant, they can still claim that.
Right.
Yeah. Yeah.
Is there any advantage to, in your opinion, like having, I mean, maybe just to attract more people to work for you, but is there an advantage to paying some people salary and some people contractor, or is it okay to
Yeah.
just go one route?
Yeah, so that's a little bit of a gray area from a tax standpoint. Here we go to
Your
gray areas.
favorite, Amal. That
Okay.
took 7 minutes.
Okay, there's no black and white. It really depends on your risk level, which we're going to talk about risk level later.
Mine is very high. Hers is very low. It's gonna be great. Let me
I
hear
have
this
to-
one,
My
Amal.
personal rate is not low. I have to advise.
You have to
My job is
advise.
to
Yes.
advise
So
you
do I.
what the rules are,
Okay.
okay?
What are the rules?
So the gray area is, as an employer, if you're paying someone who is actually, remove your actual relationship, if you set, any of your terms aside or how you're paying them, can this person be viewed as an employee? So the things you would look at, so here's the thing, when they're an employee, you're deducting source deductions, they get a T4, your CPP, EI, they don't get to claim any expenses on their personal tax return for any like business type of expenses, okay, when it's an employee. If there are any employment expenses, that's a different story, but that's what happens when you're an employee. If you pay them as a contractor and your real true relationship is as an employee, that's where the gray area comes in, because then you as the business owner can be on the hook for your portion of CPP and EI that you should have been paying on that person's salary. So the things that CRA would look at in that kind of situation would be, do you have fixed hours of work that you give them? Do they use their own tools? Are they taking on any risk in this project? Like, do you guarantee them hours? So things like that would differentiate between a true employee and a contractor. So I don't know if does that understand your, answer your question? Yes, yeah. Yeah, yeah. So I haven't seen it reviewed, actually.
Yeah, I've never heard of it reviewed
I've
either.
never heard of it.
I've never had a client.
You have? Okay. Oh, okay.
And so did the person who employed him as a contractor.
Interesting.
And in my memory, I had to also.
Okay.
Then we're like, we can't even give you a pen. We can't tell you what to do. You have to go over on your own.
Right, yes.
Pendulum swung the
Yeah.
other way. Okay.
Yeah, I was curious
I have
about,
a follow-up question.
yeah.
Because I'm talking about this with legal right now, and it is such a gray area. So you can say, yes, they have their own car and their own equipment, and they can kind of run their own hours, but the reality is the hours match your business hours, right? So there's a lot to be argued there. There's a lot
Right.
of gray area. So then
But
you
that
go,
matches everyone's business hours.
right? Yeah. So I guess my question is there some sort of ratio that the CRA looks at from maybe a revenue standpoint? So if this person is maybe getting 25% of their revenue from outside work outside of your business and 75% of the revenue is through your business, like, does that exist? Because that's what I'm looking at right now. It's very hard to determine if the CRA would be like, this person is a true contractor or an employee. And then my follow-up to that is like, then do you sort of, to some extent, have the ability to sort of indemnify yourself from that situation by getting proof from that person that if you want to continue in a contractor relationship, you need to provide some proof that 25% of your revenue is in fact coming from outside sources.
Yeah, so that's a good question and a good point because that does make a difference. Are there other contracts that this person is taking on and do they have other sources of revenue? So from your standpoint, it doesn't matter what they're doing. It's like, what is your relationship with them? And I think it comes down to those terms. So are you giving them all their work? Are you giving them all the projects? Or do they go out and find their own projects too? Are you giving them all the tools? Are you telling them how to do the work? Do you sign off on everything at the end of the day? So it really comes down to those contract terms. And if it truly is that type of relationship, then it's going to be hard to argue otherwise, regardless of what their other sources of income are. So there's no hard and fast ratio, but definitely, like, if they have a web page and they are actively seeking new clients, that helps their case.
Okay.
In your
That's
case.
a really good one too, because like if they do have other work, then they're gonna have their own computer, they're gonna have their own stuff.
Yeah.
Mm-hmm.
It's hard to say, oh, they're your employee, but then they're working 25% of the time for somebody else.
Yeah.
So like them having other sources of income is a good precursor for them also not needing the other tools because you're not setting their hours, you're not providing all their stuff and all that. So
And just to add to this, isn't that why with a lot of major contractors, they ask them to be incorporated?
Yeah, but the incorporation doesn't remove that.
It doesn't remove
No,
it.
no, yeah. It's still a high risk area.
Good times.
And I actually don't fully know this one, but there's something that when they have their own corporation, if they do get like determined to be an employee, their corporation is the one that's on the hook for the
Yeah.
remittances, like something like
Yeah,
that.
so-
that's
Oh,
why
instead
they'll-
of
so they're
her
like
corporation.
they're
Okay.
pushing their
Something-
risk to the contractor as opposed to the
Right, from a
company, which
legal
I think that's
standpoint.
what,
Yeah.
like the larger oil and gas companies will do. They'll force the individual that they want as a contractor to incorporate, so that if something does happen,
Right.
they're on the hook for
Yeah.
the remittances, like
Yeah.
both sides,
Yeah.
the employer and the employee.
Yeah, and one of the
Yeah.
ways actually from the contractor's perspective that we mitigate that is to pay them a salary.
Yeah.
Because then it limits their tax exposure to what's left in the business.
Yeah.
So then they've paid the EI, they've paid the CPP, and yeah, other expenses can get denied though. Yeah.
So, okay, so just to be clear, instead of the contractor paying for their own taxes, you could pay for taxes on their behalf and that would mitigate this risk?
No, so the contractor earns money in their corporation
Yeah.
and pays themselves a salary instead of dividends. So when they pay that salary, then they have EI and CPP, they're paying that, and that mitigates their tax exposure. So let's say they made $100,000 and they paid out 100 or 90, then it limits their exposure to what's left in there, that 10K. Yeah,
Isn't that what CRA is really looking for? It's just the EI and CPP contributions?
yeah, end of
They're
day.
looking
Yeah.
for everything.
Yeah, they want it all.
Sorry.
But they'll start with
Yeah.
CPP and EI.
Yeah,
Yeah.
Do they really love personal taxes and payroll?
Maybe they're just looking out for us 80s babies.
That's it. That's it. The 80s babies they are really looking out for. That's
You
it.
need to tap up the CPP.
That's what's happening.
Yeah.
Yeah.
yeah. So
Okay.
I can't remember where that question came from. Okay, so you're good? You're welcome, yeah.
I
Yeah.
didn't know that you could do dividend and salary.
Yes, you definitely can. So you can do a base salary, which sometimes it's helpful if your cash flows fluctuate a lot, you could do a base salary, which is nice because then you're paying into CPP. We learned a lot from COVID when people didn't pay themselves salary
Yeah.
and couldn't qualify for CERB until later. That was a big mess. But yeah, it's great to do a base salary, at least if you want to contribute to an RSP, or if you maybe have childcare deductions or anything like that. Do a base salary and then top it up with dividends if you have fluctuating cash flow. Yeah.
Why is that not more talked about? It seems like it's always
Yeah.
one way or the other, or at least.
Yeah, no, you could do a combo of both.
Yeah.
Yeah.
Amal, can you also do a management fee? Pretty sure one year I took a management fee.
I don't recommend it. So there's no benefit to it because
Yeah.
then on your personal tax return, then now you're paying CPP and EI on your management fee instead of having the corp pay
Their
the
portion.
employer's portion. Yeah, and then you get
We
into
did a whole combination of all three, so I'm just wanted to let you know.
Yeah.
It was for me, but yeah.
Okay.
I- I don't fully understand it.
Yeah.
100% need to, but I just,
Yeah.
all these
Follow-up
options.
question to that though, would a management fee make sense between several companies? So if you had multiple companies, but same thing, you're saying you get taxed on it either way.
You get taxed on it either way, and if you have it in multiple companies, it really depends on why you're doing that. Because if you have multiple companies and you own them all, there's no tax advantage to moving the money around, really, unless you have some expenses in one. And,
Losses
yeah,
that you're trying to use up.
yes, losses. Yeah.
But
Yeah.
again, if
But
you
uncommon to see it paid to an individual,
yeah.
really, because there's really no benefit.
Well, are management fees synonymous with service fees?
It's used interchangeably. We can call it what you like, Amy.
Label that whatever makes
That's
you
the
happy.
gray area. Yeah.
What do you want to
Management,
call it?
Administration, service
I just
fees.
making sure.
Yeah. Yeah, it really comes down to your, hopefully you have an agreement in place. And it comes down to what is it called in your agreement?
Yeah.
And how do we want to
In the
characterize it?
USA.
So the USA is for shareholders, that's something else.
Yeah.
The USA is just between the owners. Management fees would be for the provision of services between companies.
Okay.
Yeah. Good. Okay.
Amal, can you talk about, you're working with a lot of business owners, either from creating a business from scratch or scaling a business. So I look at the infrastructure and the foundation of both leadership, and then with that, the internal, the finances that come with it. So I see a lot of struggle with the system side of things, especially like around this, around the cash flow and how they're paying themselves, but also getting to a place where they can be on the salary, and the reasons behind it, right? Because it creates more infrastructure in the business so that honestly the women relax.
Right.
And obviously you have to have the cash flow to generate that, you have to be more organized on the financials. But just this idea of so that you can think long term, if you do want to do CPP, or they really start thinking more about investing, right? Otherwise they're just so head down in the cash flow and taking money from the business and
Right.
organizing it on the back end. And understanding what compliance is, like really understanding to be compliant with the money and the taxes. I remember when I had that aha, like I wasn't looking at the taxes properly. I was just looking, I just owed the government money, right? Versus
Right.
like, right, I'm out of compliance right now. So,
Yeah.
And how does that, setting up your business so that it's, again, you're looking forward and it's not after the fact, because that after the fact cycle just holds you back year
Right.
after year. So I just wanted to ask, from your experience on the accounting side, what do you strive to set up with clients from the beginning, right? Of what people who are doing really well do, or when you're helping someone out, that you're like, right, here's where we need to clean house.
Right. Yeah, and I think this all like a lot of it comes down to just being proactive and having communication on this stuff throughout the year versus just at the end of the year. So opportune time, we're at the beginning of the year. Not everyone is on a calendar fiscal year, but just planning at the beginning of the year for what's coming up. And sometimes we do this as business owners. You get busy with running the business and these things fall astray. And I think sometimes it's a matter of setting these things up over time. But the big thing that I see, especially in like the first year of business, I would say is not planning for the taxes at the end of the year. So similar to what we talked about with installments earlier, is money comes in the door and then money goes out without regard to how much do I need to save for either paying myself, paying my taxes, paying installments for next year. GST is a big one. So some things I've seen clients do is the profit first
my God.
method. All right, don't use the profit first.
Yeah.
Okay. Use pieces of it. No,
Use
use what
some
works
of it
for
is
you.
some of it. I think I can go through the.
Okay, I've seen. Oh, you want to?
Well, I can go
Let's
through the
go.
banking.
Yeah. do you
Which is
want-
fun. That
oh,
might help.
You go through it.
You want me to?
Yes,
Okay.
savings. Okay.
Yeah, it might help, right?
Okay, let's chat about
So
that.
often with clients, we kind of look at 3 buckets when we're looking at cash flow.
There we go with the buckets
And this
again.
might, we're really big on the buckets because they're really, people can visualize them. So you've got your banking bucket. You've got your in and out transactions that are going through your business every day, okay? Their rent, their salaries, their contractors, whatnot. You've got this banking bucket. And what is in that banking bucket should really only be a month to 2 of expenses.
That's checking.
Yeah, like it's think of it like your checking account, right? Like you do not need 6 months in there. You need 1 to 2, okay? Your next one is your savings. So this is 2020 happens again, shit goes sideways. You're starting a new big project that you're going to need extra cash flow for, somewhere in the realm of 3 to 6 months, okay? What I see often is business owners sit on that and it's all in their checking, okay? We like to take that savings and actually make you money off of it. So we want to put that in a high interest savings account. It's liquid, it's accessible, it's guaranteed. We have another preferred share structure that we use that pays a nice dividend of just over 6% right now, that we use for clients in that savings bucket. So guaranteed to fairly guaranteed, it's liquid the next day, basically no fees to very little fees on it. It's there if you want to expand your business, you want to invest, in some sort of new employee, new project, you want to buy another business, that sort of sleeve, okay? Then you've got your corporate investments. So your corporate investments would usually sit with us. They're for longer term. So you're going to expand your business in 2 to 5 years. You're going to buy another business in 2 to 5 years or retirement. So when we look at cash flow for business owners, we want to ensure that they clearly have these 3 kind of buckets ironed out in their mind, right? And so you want to be paying your salaries, and this is why Amal and I also encourage salaries. You need something regular coming in the door. Pick what it is. 2, 5, we don't really care what it is, but it's got to cover your basic expenses, okay? And having it regular, make sure that you stay on top of your tax so you don't have that large tax bill at the end of the year. So also CRA in the past has come back, and I've had a few clients, I don't know if you've had, and there was this big run where they went through people that just paid themselves dividends. And they were like, you are the business owner, but you are working in the business. So you need to receive a salary for working in the business. This isn't right. They really went after surgeons for a while. We've got a couple surgeons as clients. And that was an easy one. They're prof corps and they're obviously operating. So to receive a salary steady every month, every 2 weeks, whatever you want, just really works well from a cash flow, from a tax planning, from a CRA view. We just really want to encourage business owners to do that. It creates RSP room. It just allows everything to smoothly run, right? And then so that's in your banking, having that savings sleeve, kind of short-term, safe. Do not keep it in your checking account making nothing. High interest savings accounts are making 3%, right? Like you can make money off of it. You might as well, it's just going to sit there for the next 3 months to 6 months. And then having your longer term investments. And I do have clients that take that second sleeve and move it into the third one, and we just separate out the portfolio. So 20% of my portfolio, will just sit in a 6% dividend or an interest, small interest, and then the rest will be for longer term retirement planning, savings, expansion.
Yeah.
It tends to allow people, and then that dividend can come out of that second piece if you need a top up at year end, you know, vacation, all the things. Yeah. I don't know if that fully answers, but that's clarifies.
Because I think back to the basics is that
Yeah.
when you look under the veil, right?
Yeah.
Some people are like, or they'll have a good year and then not a good year, and that's
Yeah.
life. And it's then getting kind of back to that practice of
Yeah.
here's what really good entrepreneurs are doing, right?
Yeah.
And then it's like, oh, I can strive for that. How do I learn how to give myself a salary? Where do I start?
Yeah.
Right? Because then all of a sudden all the deductions are coming off, right?
Right.
And then that eats the cash flow, et cetera, right? So that
Yeah.
can feel like a lot.
Yeah.
Sometimes.
Yeah, and I think some of
100%.
that too comes down to awareness of what do I need to run my business,
Yeah.
and what is coming in the door, and what do I have extra that can go into my savings account, And then do you recommend that people use that for, let's say they're paying quarterly GST or
Yeah.
quarterly installments?
Quarterly
they
installments can
sit
come
in
out of
there.
that second bucket, that
Yeah.
savings bucket.
So might as well earn
Yeah.
interest on it
Might as well-
before you give it to the CRA. And
Yeah, make a couple bucks off of it, feels better, right? And if it's not something that you need to touch, for 6 to 12 months, then for sure we'll put it in something that'll earn a little bit more, right?
Yeah.
Yeah, yeah.
Okay. Does that help? with
Does that help a
Yeah.
little bit?
Could you expand on the profit first stuff? I know it's an
Right. So we don't recommend 7 bank accounts or however many it is. I think what I've seen it be successful is, okay, we know that these are operating expenses. We know that this is, let's say, GST coming in the door, and this is how much I'm going to pay. So where I've seen it successful is, okay, this is what we've collected for GST. We're going to set it aside in this account and not touch it until we pay our GST. Whatever's left in there, we can take back out. So I've seen that. I don't think we really need like the owner's comp account and all of those different accounts. It's really, I think, the valuable lesson I've seen in that is just using it for tax savings. Just setting aside what you think you don't need, putting your tax money in there, and then at the end of the year assessing, okay, this is what I need to pull out. Here's what I have left. Just helps to prevent that balloon from growing of, I owe tax at the end of the year and now I have to pay installments for next year, and you get into a cash flow bind. So that's where I've seen it successful and useful.
So how do you shift away from it? Because as somebody that is not an accountant, and not geared that way, I really like it for like understanding. It's almost like a form of budgeting.
Right,
and
it
I
is.
just see so clearly.
Well, I would say, does it work for you?
Yes, but I've had complaints
From your
my
accountant,
bookkeeper.
yeah.
Yeah.
I
can
think
see
if
how
it works for you,
complicated
you could stick with it. But my suggestion would be, let's say you have a separate account where you move your owner's comp to this account and then you take it right back out. Why have that additional step?
it is. Right.
Like, why not just take it out of the account if you know that that's how much you need? I just think that the transferring between accounts creates a bit of a more
Yeah.
work, a bookkeeping,
Bookkeepers.
bookkeepers night.
Rachel might have words on it.
Rachel.
I think that might be my perspective on all this in terms of how you just
Yeah.
pay yourself, is that, to your point earlier, there's not a huge difference in taxes between dividends or employment. So I think everyone's different. So some people, it just works for them to pay dividends. They don't want to pay into CPP. They'd rather
Yeah.
take that money and pay it into their TFSA or whatever. So I don't think there's any one fit
Yeah.
solution. I think if you're great with your cash and you just want to do dividends and you know what that means and you're ready for installments and ready to know that you're going to owe a huge amount at the end of the year, that's great. If that freaks you out, then do everything through payroll and stay organized. But there's no
Yeah.
real like one shoe fits all.
I just think
Yeah.
everyone that gets incorporated should be forced to do a course.
Yeah, and that's part.
There should be a course with the documents. Yes, yes. Yeah.
It's
It's not like, here you go.
Overwhelming when
Yeah,
you don't know about it, but if you learn about it, you just get in the groove and then you know.
yeah.
You have
right, and
installments,
that's
you
an
have it.
unfortunate piece about like the education piece when starting with an accountant is I love it when I get someone newly incorporated. So I'm like, okay, great, like my opportunity to set you up real
Fresh
nice.
meat. I can
Yeah.
get this organized the way I want it. Yeah.
It's great. It
Yeah.
makes all the difference versus when you're 2 or 3 years down the line and you're trying to figure out what to do differently or how to reorganize. And so, yeah, there's always hope.
Yeah.
And so
Yeah.
I would say just take what values are working for you out
Yeah.
of the profit first. Really analyze that and say what is it helping me, and then just to simplify the process as best as you can. Yeah. So.
Amal,
Yeah.
I mean, I feel like they introduced Calgary to profit from back in the day, back in 2016. So I get as an entrepreneur how it totally speaks to the entrepreneur, right? Like paying like all the cycles, everything it sets up, like that speaks, I think, to a lot of entrepreneurs. I think what they're bridging right here is that, and it gives a system and a structure. And if you do it, then there's too many accounts and they're all over the place, and the accounting becomes a mess, or it just becomes, it can cost money to do all of that,
Yeah.
right?
Mhm.
And so I think after you like, echoing what you said, you're gonna take some, I still do things for profit there, so that'll never give up, right? But at the same time, I think as your business gets more complicated, that's what that's what you're speaking to, and that's what you offer in the relationship management of the service that you give. And it's this idea that when you are working with an accountant, they're going to show you actually this is just a simplified version of this, and maybe, or if you're working with her or someone else from the beginning, you're going to see that. But eventually, you're going to want to do more strategic things, and there's other structures that offer that same framework, if you will, right? So that's how I'm hearing all of it. So when you're like, no,
Yeah.
I see why.
Yes.
I see why, but then it's also like, okay, so then entrepreneurs are like, okay, they're going to transition, right? It's like, okay, well, what am I going to transition to?
Right. Yeah.
And then there's a whole nother level of education with that, which is often not in entrepreneurial language, right? It's accounting language, and then you have to learn more, and then that becomes more risk, right? So I just think I see it as a mixed bag.
Yeah.
I think there's a big education gap.
And I think it's a growth thing as well. So you might start with that and then realize, okay, this is not working, and shift and move more towards, okay, like as you grow your business, you might not need that, right? But maybe in the beginning when you're budgeting or starting a business, first few years, that may be more important. But as the business scales and grows and cash flows improve, then you're moving more to this kind of structure over here. So, yeah. Cool. Okay. What else are we going to chat about?
We're going to chat about investments.
Okay. That's all you.
And we're going to throw around the CDA.
Right.
Yeah. So we're going to talk about, so within your corporation, if we go back to kind of those three buckets, the third bucket where you're saving for something longer term, retirement, expanding your business, that sort of thing. We want to invest that in the corporation. We don't want that coming out as salary and dividends to you personally. We want to keep it in there for tax planning reasons.
If you have RSP room, I like it too.
If Amal does the calculation, tells me to do it, I'll do it. But I don't always want to take it all out because there is a tax. There's a tipping point.
Yeah,
There's a tipping point.
Yeah.
So we tend to leave some money if the clients don't need it personally. We leave it within the corporation and invest it within the corporation. Okay. The corporation then pays tax on any growth. And typically your corporation would pay a lot less tax than you personally. The idea is to create a pension-like, and I use that word only because people have a picture of what a pension, kind of how it operates and what it works. So is to create a pension in that corporation for you, in that in retirement you can take, and that can supplement your retirement income along with some of your RSPs, TFSAs, along with CPP if you've decided to pay into it. Back to, you've got multiple buckets for me to plan your retirement with. This is really just making my life a lot easier. So you've got the CPP bucket, you've got, RSP, TFSA, and then corporate investments, okay? I get asked a lot as to why we do it, and there is a tax reason why. Sometimes we don't want you taking out the extra income. Maybe it'll move you into a different tax bracket. Maybe you don't have RSP room for us to, bring you down from a tax bracket, that sort of thing. The investing within the corporation, we can buy everything in there that you can buy personally.
Yeah.
So if there's a certain stock that you want to buy, we can buy that within the corporation. It's just the corporation's owning it, and you as the business owner are going to sign off on it because a physical person needs to sign off on it. So the corporation doesn't limit you on being able to purchase different types of investments and that sort of thing. Okay, we get that question a lot. The fees are not any different. So you don't pay more to invest in a corporate investment account than an RSP. So there's no fee change there either, okay? There's three ways that we can, there's three main ways that we can earn any sort of return. So you can receive capital gains, you can receive dividends, and you can receive interest income. Capital gains, so far CRA is letting us still run those through at 50%. It's great news. When they open government, let's see what happens, but let's go from there. So far, we still have 50%. So for every dollar you earn in a capital gain type of investment, you pay tax on 50 cents, okay? Dividend, you pay tax on 66 2/3. There's some fanciness that Amal has to do, but net, you pay tax on 66 2/3, okay? And interest-bearing instruments, any return that you get, you pay tax on 100%, okay? So we want to, my role is to try and save you tax and try and keep you in that 50 and 66 and 2/3 if I can. We have to manage risk and we have to see what's going on in the economy, but of course, that's where I want to stay, okay? When we use that 50%, that capital gains, and we trigger those gains, 50% you have to pay tax on, and the other 50% is called the non-taxable portion of a capital gain. And that goes into something called your capital dividend account. And Amal creates it literally over here in La La Land. She does. She creates it. It's over here. And we don't. Amal credits money to the capital dividend account. Okay? That money can then be extrapolated out of your corporation tax-free. Not free game. Don't do it free game. Amal will really get mad.
Yes.
Within a certain timeline, it will be free for you to take out. Okay? So you can take that out yearly for expenses if you need it, that sort of thing. But if you don't need it, we have quite a few clients that keep it in there and they credit their CDA on a regular basis. So we'll sell stock or ETFs or whatnot, and it'll credit this capital dividend account. And the mindset behind it is that you've got a pool of tax-free money sitting in your corporation that you can take out whenever you need it. 5 years, 10 years, 15 years, really, whenever you want. Okay? So when those capital gains changes were proposed last year and everyone got really upset, one of the biggest reasons was because you could put less money into that capital dividend, which meant less money could come out to the business owner tax-free.
Right.
Okay? And so it's an important thing to know when you're investing, because there is this there's this way of creating this under certain guidelines. An election has to be filed by the accountant to allow you to take money out of it, and they still need a calendar year or not anymore?
You don't need a calendar year to take it out.
You
no.
can take it out after the election's filed.
You should take it out after the election's
Good news.
filed. So
Don't do it before.
don't do it before.
Don't do it
You
before.
can't just take money.
That's not a gray area. That's a black and white area.
But it's not. It's very yes. It's very,
Very
black and white. You're
Don't
right.
free game that.
You don't. So yeah.
It's very bad. There's a lot of
accumulate
penalties.
it.
Yeah.
Well, you can take the money out, but it won't be a capital dividend until we formalize that
Yeah.
process.
Yeah.
And so
we want it to be.
we want it to be formalized, and we want it to be a minimum level before the money is taken out. So you don't want to do a capital dividend election for like $5,000.
No.
So fees
gotta
are
be a
usually
big
at
lump
least
sum.
$1,000. So yeah, I wouldn't recommend taking it out before it's like in the, at least 20K ish. So that's where we usually your accountant is looking at that, and they will let you know if you have a balance in that account that is ready to be withdrawn or formalized, so you can withdraw it.
So you can withdraw.
Yeah, and when you take it out, it's totally tax-free, which is nice.
Yeah.
Yeah.
Sorry, can you,
Questions?
specify tax-free?
Like tax-free.
Yeah, no, like legit,
zero.
no dollar bills
You don't even
need
put
to
it on
go
your
to
tax
CRA.
return. Yeah.
It doesn't even go on your tax returns.
Doesn't
There's
even go on
actually
your
not even a
personal tax
line
return.
for it.
Yeah. So that's the non-taxable portion. Does everyone clear on a capital dividend or capital gain?
Capital gains.
What
So
it is, how it arises?
yeah, so we buy a stock. Let's buy RBC. It's a nice standard issue. We buy it for $100. We sell it for $200. That difference between the 100 and the 200 is a capital gain. The taxable portion is $50, half of that 100. So you now pay tax on that $50. The other 50 credits to your CDA
And comes out tax-free.
and comes out tax-free down the road. Legit tax-free, not half-assed tax-free.
I'm sure a very dumb question. So why are we not doing all of that and not taking any income at all?
Well, you need something to live on.
We have to.
Yeah.
Also, you need the
How long do
gains,
you have to
right?
wait to take it out?
You can, honestly, you have to pay a little bit to take it out.
Yeah.
Like there's a small
Let's say
election.
50%? 'Cause
No, it's not. No, it's very small. It's very small. I've got clients that build them up for, I've got clients that don't need the cash and are waiting for retirement on, and they've got 6 figures sitting credited to their CDA. So you can take
So
it
the
out whenever you
danger-
want.
I want to talk. There's a danger there.
Oh yeah, what's the danger? Yeah,
Well,
black
the
and
danger
white.
there
Black
is-
and white.
You sell the stock though.
Right. Yes. You have to sell it. And
Okay.
Yeah.
So yes, you have to sell it. I can also rebuy it.
You would sell it and rebuy it.
Yeah.
Oh, that's smart.
Yeah, I did a lot last June. Well, I didn't. but Tori and Taylor and Pedro did, and all of my team did it a lot last June. Oh yeah, we rebuy them the next day.
Yeah, so the
Yeah.
caution with that, with accumulating it, I guess
Yeah.
I like that idea of selling it.
You like the selling and rebuying?
rebuying. I like that idea.
You got to watch for short-term trading though. They don't like that. We got to be careful on that.
Right.
Yeah, but stock is okay. Stock's fine.
So, but if you then have, if you accumulate it and then
Yeah.
you have a loss, it grinds against that balance.
It does.
So you also don't want to go years and years without taking advantage of it.
Yeah.
When it's at a certain level, you want to take it
If you
out.
realize a loss.
Yeah, or if you know you're going to sell a stock that
Yes.
might have a loss on it, then we do the dividend election first.
Yeah.
You grab your gain and then you sell that stock and trigger the loss
Yeah.
after. Yeah,
But
yeah.
we don't.
A capital loss affect your CDA?
Yes, it reduces it.
Reduces it.
Yes.
Yeah.
I'm gonna ask a dumb question.
It's not gonna be
No-
dumb,
no
Mark. It's gonna be
questions are
good.
dumb.
I'm gonna like it.
How do
Yeah.
I know, Julie, if I have a CDA?
Oh no, this is
I'm
okay.
gonna tell you.
So
To make it for me?
no. She.
I got you, Mark.
Remember when I said it's over here in La La Land?
Oh, okay.
Mal doesn't like. It is over there in La La Land. It's not anything that's
What did I, what was it? NFP?
NFT.
NFT.
Yeah.
It's an NFT.
She.
That's my Wellington house.
You cannot see it on your Wellington Altus
No,
because
it's
what
on your
happens
tax.
is we've sold it and then I've rebought.
Okay.
So it's a number that's in your.
Your tax return.
It's on your
It's
tax
on your
return.
tax return.
It's there. It's over
CRA
here
knows it.
in La La Land.
They're tracking it.
It's just nicely floating
Yeah.
until you need it.
Is it on my CRA profile?
No,
No.
they haven't.
No.
We're waiting for
CRA
that.
doesn't even.
Yeah.
No, come on, Mark. No. 2050, they'll have it on there.
Yeah.
They don't want them.
No,
yeah,
they know
because
it. They just don't tell you it.
They don't tell you it because they don't want you to know it. So then you take it out and you don't pay tax.
Precisely. So it's there. So it's not
Yeah.
money. It's not money.
I mean,
well, it kind of
it is money.
money.
So it is so abstract, but it's also so valuable.
So funny because I never thought of it as abstract until you.
I have so
And
many
I was like-
clients are like,
it was
"What
clear in my
where is the
head."
money?" I'm like, "Oh, the money's reinvested," and they're like, "But it's not a separate account." I'm like, "No, it's not a separate account, but you can credit it. The balance sits there
Right.
each year. If you take it out, fine. If you don't take it out, that's
So, but
okay.
a
We
great
just
idea. It's
reinvest
like
it.
to keep that portion invested. So
Yeah.
when you want to take it out, you can take
You
it
can take it out. Yeah,
So
exactly.
in my mind, I'm thinking you take it out and put it in an RSP, and then you get more money. your refund.
I mean, I prefer if they take
I
it
like tax
non-taxable
refunds. Like,
into TFSA, but yes.
get your money back.
Yes, exactly.
So.
But I have a couple clients right now that do that, have done that a couple times, and their mortgage is up in, I think they have another renewal, so I think they're like 7 or 8 years out from their mortgage being done.
Okay.
And they won't, I think they've got 2 years left and then they're gonna do another 5, so maybe 7 years left. Then they're gonna pay a lump sum, so out of their corporation, onto their
the
mortgage, tax-free,
Great idea. Yeah. And yeah.
right?
Yeah.
If you're getting closer to the end of your mortgage, but you're not fully done. So it's an idea for that. So you're letting it sit there for, well, I think they're in year 2 or 3 right now.
Yeah.
So
And so
plus
they have
7
it
years, year
invested.
10. So I guess we better not sell any capital losses.
Don't sell capital losses.
Just keep gaining.
Yeah, but I like
Yeah.
that strategy actually.
Yeah.
It's interesting.
That's a good one.
Yeah.
Yep.
Do you guys want to comment on, because I live this, real estate, those of us invested in real estate or interested in investing in real estate, buying and selling, how does it work with capital gains, timing of selling?
Yeah.
There's
So what was it? What did I tell you? It was 1 year.
1 year. It's 1 year.
Yeah. So if you're buying and selling before 1 year, then it's a capital gain, even if you live in the property.
Even if it was your
right?
primary residence.
Yeah.
It's just, it's not an off.
For CRA, or is that they start poking around?
Well,
No, well,
kind of great.
it's one that
I think
gets,
Out too?
no,
so
it gets.
depends on life events. It
Yeah.
depends on your life events.
And
so if,
my
yeah.
accountant who used to work for the CRA said it's a very big one that they go after. It's like
No,
a
They definitely do. I just
low
didn't know.
hanging fruit
My
for them.
understanding was it was a primary residence, but if it's within that year, then they're all over it, like they're looking for that.
Yeah.
yes, and
Yeah.
and that's where it comes down to life events. So if there was some life events that forced you to sell your property or to move out,
Yeah.
they have a list of life events. I can't remember what they are, but that's when they'll consider it not to be a capital gain and actually allow you to claim that principal residence exemption.
The reason they put it in play, was it not for foreign investment? People coming into Canada buying, like I thought that was what insinuated it. Pardon?
Yeah.
Yeah, but they had initially put it in because there was, as a way to slow down, because people were coming in, buying a property 6 months later, selling it, and saying they lived in it, and so there was no.
I would limit that to foreign. I would.
Yeah.
There's a lot of developers here where, and that's what they do. Actually,
That's
I
what
read
they
a
did.
recent case about that. And
Yeah.
it was a case, a CRA case, but the taxpayer had lived in a property, claimed it as her principal residence while she was separated. But when they actually dug into it, like she really wasn't separated. The ex-husband was helping to support the renovation, and she claimed it on her personal tax return, and she lost the case.
Yeah, not
So
good.
it really depends on the facts and circumstances, but
Yeah.
when you have a legitimate reason, then
It's okay.
Yeah, it's usually supportable.
Yeah.
Yeah, and the worst case is like CRA comes and they're going to knock on your door, ask you questions. You do your best to support your case, and the worst case scenario is, they deny your claim and you try to fight it. But
Yeah.
you're not going to jail or anything like that.
Yeah. They're not that.
Yeah,
They're not that severe.
yeah,
Yeah.
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 How does it work when, I think we've talked about this, Amal, but I don't remember. How does it work if you bought a property X amount of years ago, like let's just say 8, and it was worth a certain amount of money, and then now it's worth less? Is that a capital, can you use that as a loss?
It's a capital loss.
It is.
Yeah, yeah, yeah. So the CDA concept doesn't apply to people.
Yeah.
So the capital loss, you would just hold it. It does get tracked, and in the future, if you have a capital gain
Right, you can use it
you
again.
can apply it against their, yeah.
Yeah.
So, yeah, okay.
Yep.
All right, what
Good.
else we have?
I don't know what else we had on that
Oh,
list.
we talked about, tax deductions.
Close your
That's
ears, Amal.
my hot topic.
Just close
Well,
your
I
ears.
wanted to chat about a few things that I get a lot of questions on.
Yeah.
So one of them is HSA, which I just recently found out you do HSAs.
Yeah, she found out the other.
So HSA is a health spending account. And when you have a corporation, you can open a health spending account and pay through your medical expenses. So this
Yeah.
is not like cosmetic stuff, but legitimate medical expenses, chiropractors and physio and optometry, any of those things
Yeah.
through the corporation, through that health spending account.
Braces. So many braces.
What?
Braces.
Braces,
Yeah.
orthodontics.
Orthodontics.
Correct. Yeah, those
Yeah.
things are expensive. Other things that are kind of off topic, not off topic, but edge case scenarios, like, children with disabilities that might have special tuition costs
Yeah.
that need to be paid. You can run all those through the HSA. So it's a formalized account that you set up with an insurance company. The SCAL can help you with that.
Yep.
And then what that allows you to do is pay your medical expenses through your corporation. One caveat to that is you need to be on salary. So even if it's
Yeah.
a small salary, like 20,000, 15,000, whatever the case may be,
Yeah.
but it has to be, you have to be on salary to do that.
Yeah.
And any other employees that you might have in your corporation need to also be eligible for that, and you'd have to provide the same thing to them. It doesn't have to be at the same
Amount.
They don't have to be the same limits.
Yeah.
Yeah, so if you have employees and you want to give them a lower HSA limit and you're at a higher, that's totally fine, as long as you provide it to them as
Yeah.
well. That's how to structure it so it's deductible. And then it simplifies personal tax too. That's why I like it on the personal tax side.
Makes your life easier.
It makes your life easier too. You're not
That's
collecting
great.
receipts at personal tax time. So then those expenses don't get claimed on your personal tax return. It's just claimed through your corporation.
Yeah.
Yeah. Yeah. So that was my HSA. The other one, I bet people want to talk about auto expenses.
Amal loves auto expenses.
I don't love auto expenses, but it's a question that comes up so often.
Yeah.
Should
You
I
get it
buy a
lots.
car? Should I lease a car? Can I expense my car through the corporation?
Yeah. So you just write it all off and it's no problem. Doesn't matter what it is, right?
This-
Yeah.
You could.
Just put it
I
all
mean,
through. All
I'm
the
not
gas.
I don't
a write-off.
police that. But again, I have to share the risks and the risks associated with it.
Yeah.
So-
a certain amount.
Right, and I think that this comes down to what type of business you have as well. So if you have a business where, let's say you have a delivery business and you need a delivery truck, obviously 100% that goes into the corporation. But there are other types, let's say you're a consultant or an accountant. You know, I'm not out at clients all day. Most of them are virtual, or some of them come to me. I occasionally visit clients. So I really can't justify owning a vehicle through my corporation and writing it off through a corporation. So to me, if I did, that would come with actually some adverse tax consequences, because what the CRA deems is that, okay, my corporation is paying for this. There's probably a personal benefit to me because I'm probably using that car to shuttle the kids around and, you know, go to Costco on the weekend and do all the things that we all do. So there's a taxable benefit to me. So what they calculate, and it's actually very harsh, the calculations is they calculate what is the benefit to me of using that vehicle, and I would have to report that on my tax return, and I actually should be paying tax on that if that was the case. So if it was through my corporation, those are the tax implications to me. How I like to structure it in a business scenario like that is you personally own the vehicle, it's your car, which it is your car, and then any business expenses, any business use of it, we reimburse you as a shareholder. So you drive to clients,
Yeah.
you know,
Pick a percentage.
Estimate
Ish.
your kilometers.
Yeah.
Yeah, and then we reimburse you based on rates that CRA has already given us. So those rates include everything from like maintenance to gas to your oil changes, whatever, your insurance. That rate encompasses all of those expenses. So really no vehicle expenses should run through your corp. When that's the situation, you just claim the kilometers. Okay, the others, yeah, go ahead.
The kilometers don't start though until you get to work, right?
You're right, yeah.
Very gray, very gray.
So if you normally work from home and home is your place of business and you need to visit clients, then that to and from your clients is going to be tax deductible. Yeah. So like real estate, for example, they use their vehicles a lot.
Yeah.
And sometimes it's actually more advantageous to own it personally and have kilometers reimbursed to you because there's no limit. Whereas if you lease your car, I looked this up for you, it's
Yeah, you
$1,000
did.
a month.
Yeah, 1,050.
$1,050.
Don't jip me on my 50.
It's $1,050,
Yeah, I want my
but that
full
runs out.
1,050.
That runs out after your lease is up or you've paid out the car.
Yes.
Whereas
But then you can amortize the car.
So CRA says.
If you buy
Golden
it
Girl
out.
really went through a
Yeah.
lot.
True,
So CRA says anything more than $1,050
is not tax deductible as a lease.
No bueno.
Yeah. Or if you buy
No,
a
I'm
car,
right around there. I'm good. I know. Don't you worry. You should.
Well, hold on. But
Oh.
before you change it,
Now what
Here,
you can
I'm
tell
gonna-
me.
well, you have to have a budget because over $37,000 you can't tax deduct.
Over 37,000 what?
Dollars, $37,000. So if you buy it
Yeah?
and the value is over $37,000, which like,
Didn't you know it's
you can-
36,999? I don't see a problem.
Sure. Okay. All right. Well, so you can live on the edge if you want. I'm good with that. But those are the rules, Julie.
36,750. I'll give it more wiggle
gonna
room so
buy
it's
it
more
out?
realistic.
Yeah.
I don't know. I'll figure it out then.
If you're financing it, if you purchase the vehicle and the
Yeah.
cost is over $37,000, anything over that you can't depreciate. You can depreciate up to $37,000. But here's the thing: is if you reimburse kilometers, there's no limit.
It's free
Because
game.
it's reimbursement.
Free
you
game.
just have to support your kilometers, which sometimes it's more advantageous.
Yeah.
You know, in certain industries and
Yeah.
certain businesses, if you're driving a lot.
Yeah.
But if it is through your corporation, you feel that you can, you know, support that. Just make sure your insurance, your registration, all of your supporting documents are in line with that. You know, we don't want personal insurance, personal registration, and then a corp that is
Corporate
just, a
vehicle.
vehicle paid by the corp.
Yeah.
Yeah.
So,
And that-
well, I guess two things. So if somebody wants to upgrade to a swanky vehicle,
Yeah.
which is more
Didn't even prompt it.
$36,000 rate.
What else did we want to talk
What
about?
are they
Oh,
doing?
fees.
Are they just buying it, either buying it outright, or are they just, are they amortizing it, or are they?
So Yeah,
you often see that that is part of the business. And second, is there any new apps for kilometers? Because that's also.
Oh.
do you know? I don't know.
No.
about that.
Do you know what I do?
Studio has a.
I mean, before this year, well, still do it. January 1, I have a reoccurring yearly reminder to go record my kilometers.
So I
Swear to God, I do it every year.
That's it.
Flashes up at like noon. I'm like, boot, doot, doot. Go see the car, record it. I actually take a picture. Done.
There actually is apps now where
I'm sure there's apps that are legit, but that's what I do.
it tracks your.
Oh, Mile IQ. Okay.
And I just
We have
take
a suggestion over here.
Oh,
Mile
yeah.
IQ.
and realtor, so she would.
Okay.
Yeah, yeah.
Okay.
Yeah.
Yeah.
And it tells
Yeah.
me everywhere, and I can even put like my kids' school, my kids' daycare, home.
Oh, so
Oh,
you're
neat.
legit.
So you, like,
Little
went
pop-ups,
home.
that was
Yeah.
She's legit.
And you can put like you were a passenger, for example, if you were in an Uber, because it tracks that you were in a car. So then you have to be like, oh, I was a passenger. Or let's say you go on vacation, then you just click at the side, it says on vacation, so it says like, it's awesome. And then it sends you an email once a week on Monday, and I just look, and every Monday I categorize it. And it's like you switch business, switch personal. Super easy. I thought everybody knew about it. Mile IQ.
I take the picture.
That's smart.
Mhm.
Love
Yeah,
that.
and I think it's like, it depends what type of business. Like as
Yeah.
a realtor, you're probably going to a lot of different locations.
Yeah.
I might know that I go to, certain clients 3 times a month.
Yeah.
So I'm like, okay, this is my estimate, and here we
Yeah.
go. Good and done. And
Yeah.
yeah, I've seen reviewed. Vehicle expenses
Yeah.
is a big.
I've had clients
a hot
tell me that
topic.
it's been reviewed.
Yeah.
Yeah.
Yeah, we've gone through that a bit.
Yeah.
So
It is a good one.
yeah. So I hope pass on the message to all your friends.
Yeah.
We'll track if that question goes down in popularity.
Yeah, exactly. We'll see.
Maybe there's more.
For me, the one I get quite often is, can I write off fees?
Right.
So investment fees. So your RSP and TFSA fees have to be charged to the appropriate account. So your RSP has to be charged to your RSP, your TFSA has to be charged to your TFSA. No, you cannot write them off. That's pretty black and white. You can't monkey around there. Even I got to go black and white on that one. Your corporate investments, you can write off, the corporation can write off that. They can write off the advice fee. So how we structure our fees, you will get a document every year showing you your advice fee so that you can write that off against the corporation. So yes, you can. Insurance premiums,
Oh, yes.
no. It's a no. And this again, very, very concrete. Because life insurance is paid to the beneficiary tax-free, the money going into it has to be tax paid. If you write it off, it is in essence not tax paid. So insurance premiums are not something that you can write off, whether corporately paid or personally paid. It's no bueno. And I'm
That's a
meaning
good
like
one,
life
yeah.
insurance, critical illness, disability, no bueno on that one. Yeah.
Julie, can you talk to, this is always my point of confusion,
Which one?
critical illness versus disability.
Critical illness is if you get, it's a lump sum tax-free payout. If you get diagnosed with, depending on your plan, there's 3 main: life-threatening cancer, heart attack, stroke. Key is life-threatening. So you can't be removing a mole that is stage 1. They won't deem it as life-threatening. Critical illness was invented in the 70s by 2 African doctors. It was actually invented in South Africa because they had so many patients that didn't want to get better. They wanted to die because their family had life insurance and didn't have protection if they lived.
Oh, wow.
So it was actually invented by doctors, not an insurance company. And so Canada is one of the few countries that still offers different kind of bells and whistles on critical illness. And it's probably the thing that my business owners have the most of because of the flexibility on it. So you're diagnosed, you don't, whether you work or you don't work, it doesn't matter. So I'll give you an example. When my dad was diagnosed in 2011 with Lou Gehrig's disease, he still worked for 9 months. So he got his critical illness. It didn't matter. But while he was working, he could not claim disability, right?
Okay.
You can use the expenses you can use the lump sum from critical illness for whatever you want. So I always say to clients, like, you can pay down your mortgage or you can go party in Tahiti. Like, CRA has no there's nothing. You could go do whatever you want. So the flexibility and the freedom around it is really good. It does have to be life-threatening. I think the most comprehensive one has 24 illnesses, including loss of independent existence, which is a good one to have covered, because it's if you can't do 2 or 6 of the can't remember what they're called, activities of daily living, basically.
Okay.
Yeah, so you can't feed yourself, you can't get out of bed, that sort of thing. So coma is a big one that gets flagged on that one. So that's critical illness. Disability, the definition behind disability is you can't do the substantial duties of your occupation. It's amazing. It's so gray. It's so gray.
Sorry, and this is personal disability, right? Because we
Yeah.
have overhead in a business.
Overhead's easy. Overhead's very concrete. Personal disability, very good for someone who has a very tangible job with very clear duties. So I am a surgeon. I operate. It's like, okay, that's very clear. You know, I'm an accountant. Can I work from bed? Can I do Zoom calls? Can I partially work? Can I not? It's harder to claim. So I don't have as many clients that have disability. It is very concrete if you're running a business, because you can't run the business properly anymore. And we load on a lot of partial disability so that a business owner could work half time, 3/4, and still get paid. So that's how we solve that.
And sorry, on that piece, you should own it personally?
Yeah, you have
Right.
to.
Okay.
Yeah, you technically have to, because you're receiving the benefit tax-free. The monthly amount's tax-free.
Right.
So you have to have paid tax on the premiums.
Yeah.
So you shouldn't own it corporately. I've seen it with other advisors. It really gets monkeying around at tax time. It's
Right.
not good. And
Right.
accountants don't really like it,
don't
my
like it.
understanding.
Yeah.
They'd rather see it owned personally. Critical illness you can own corporately. Most of clients own it corporately. Yeah.
And I would say the one exception on the life insurance is, I've seen it a couple times, when the bank requires you to have the life insurance.
You can
then
write
you
off
can
the premium.
tax deduct it.
Yeah, you can write it off
Yeah,
because
so
it's
maybe terms of
mandated.
a loan or something.
Yeah. Yeah.
But
That's the
then-
only time I've seen. Yeah.
Yeah, that's the only time.
Yeah.
So, and then when it's a business overhead disability, the business owns it.
The business owns it, the
Right.
business receives the benefit, and the business is the payer.
And then when would you use that? When,
So if the business owner can't function, the money goes into the business to continue operating the business.
right,
It is quote unquote not allowed to be taken out for the owner's salary or dividends.
okay, so when you have tangible,
Yeah, so
Like
it's, you know, I'll use mine. So I have one, it's enough to pay my rent here. It would pay my vehicle expenses. It would pay.
when the new
Good
car
point.
comes
Yeah,
in.
good point. Yeah, no, I should check that. It pays everything that's needed to run the business. It pays all of my team's salaries, that sort of thing.
Right.
It does not pay my
Doesn't pay
income.
you.
Correct.
Right.
But it pays everything to keep operating the business exactly as it is today.
Yeah, we see that in a lot of dental practices or
Yeah.
like healthcare practices.
A lot of
yeah.
healthcare.
Yeah.
Yeah, I have it on quite a few different types of businesses, but
Okay.
it's a great one to have. It only lasts typically 2 to 3 years. So business overhead won't pay out
Oh, you can't-
typically longer than
Oh.
24 to 36 months.
Oh, the proceeds.
Yeah.
I see.
They'll
Okay.
stop after 24 to 36 months. So the business owner is going to have to make a decision. Are they coming back to the work? Are they selling the business? What are
Okay.
you doing? But it buys you time to be able to decide what to
Mm-hmm.
do with your business. The other thing it does is it allows your business to keep operating from a financial standpoint.
Yeah.
So your business is still as valuable or close to as valuable.
Right, so you can sell it.
So you can sell it. Yeah.
So I understand about the life insurance, but can you talk about when you have, if you have a partner and you have like business insurance in the business on them?
Oh yeah. Yeah, so there's a few ways you can set that up. I mean, I might as well use Clark and I because we've got some insurance on each other. So a few things. So in the corporation, if you have a shared corporation, okay, you can have the insurance policies owned by the shared corporation. They are the owner, they are the beneficiary, and they are the payer. Okay,
Right.
so everything flows through there. If something were to happen, you can do one of two ways, I guess, to get the money to buy. The whole point of it is to buy out the other owner's shares and to make the estate whole, right? So you've got two people, one passes away, you don't want that business owners, if they have a significant other, to come into the business. So that living shareholder can now use that money to buy the shares of that business. So they own it 100%. Okay? If you have two separate corporations, so again, you can do it both ways. I think it's called crisscross, and there's another one. But typically what we see is, like I own insurance on Clark in my corporation, and Clark owns it in me, in his corporation.
Then you have a joint corporation?
No, we're separate. So there's a document that says, if it's in our USA, so our shareholders agreement, it says, God forbid something should happen, this corporation is allowed to purchase those shares with proceeds from life insurance, right? They call it a
You're buying the
crisscross.
other corp.
Yeah, to buy the other corp.
Okay.
Yeah, yeah.
Okay. That's
So,
interesting.
but we don't have a shared corp, right? So we have two separate corps. It's easier if you have a shared corp because then you can just put it in there. Yep. And then if you don't have corps, so I've seen some partnerships that still they each just receive the funds. They have a very informal arrangement.
You have life insurance on
Personally.
someone else.
Yeah, exactly. So you would own it personally. Yeah, and you would just have a USA that allows you to buy the shares of that business. I mean, it's not really, it's a partnership agreement that allows you to buy those shares upon passing. Yeah.
I think this is just to slide in there.
Yeah.
Just as you're talking about life insurance, I think it's just interesting. Something to just keep in mind is that when you have a life insurance policy, it's not necessarily to leave money to someone as well.
Yeah.
It's like there's
a good point.
Yeah, it's a tool, right? We're using it because when you pass away, your estate, there may be taxes owing on your estate. There's things to consider on that perspective. So those proceeds of the life insurance are used sometimes to settle any of those taxes or anything that might be owing on your passing.
Yeah.
So just something that sometimes, yeah.
In Canada, when you pass away, you have deemed sold all assets on the day that you pass away. So there's provisions,
it a big
there's,
garage
yeah, it's not a good day. Doesn't matter what the market's done, everything's deemed sold.
Yeah.
And we have to backdate things to sell it on those days because often we're not actually selling on that day. There is provisions between partners and significant others and spouses for rollovers and that sort of thing. So there's definitely elections that can be made. But it is clear that you have sold every asset you own as of that day. That is how it works. Corporations are different. Corporation keeps living if the owner's no longer there. Right? But obviously things have to be, so if insurance flows into the corporation, great, that allows us to settle the corporation. This is why we typically want insurance personally and corporately. Because we want to sell your personal affairs with the proceeds from the personal insurance. We want to sell corporate affairs with corporate insurance if we can. So typically we see both. Yeah.
Yeah.
Yeah. Yeah, yeah.
I'll ask you again.
So
on
you're
that. That makes
recommending,
sense.
sorry, I have to step out for a second.
Yeah.
You're recommending that, so I have all the insurances personally,
Yeah.
right? But I've never thought about it with the business. And I'm almost kind
Yeah.
of thinking about why no one recommended it.
Yeah. I mean, again, every situation's their own. It would have to be based on a need.
Yeah.
But there usually is a need for, as a business owner, for insurance in the corporation and insurance personally, right? Everyone's got personal assets, personal need for sure. Significant other, kids, that sort of thing. And then there's also the corporate need to settle everything within the corporation.
I got critical illness insurance when I was like 25, so I can't even remember it anymore. But isn't there like if you're not sick, that you can pull money out at some point?
Yeah, so there's a return of premium on it. There's a couple countries that still do it, and Canada still does it. So if, Amal's not going to like this, it's your favorite gray area.
I'll plug my ears.
You can
Bathroom break.
No, CRA has not ruled on it, so we're still good. And I just read the up-to-date report from November. They still haven't ruled on it. You can own the critical illness in your corporation. Okay, so you pay the premium, let's use numbers, so $10,000 a year. You own it in your corporation, okay? You need to give the return of premium portion. Let's say it's $2,000 out of that 10. That can be all paid by your corporation. It needs to be a taxable benefit to the employee. Okay? If you do not use your critical illness, depending on your plan, 15, 20 years, you can get all the money back. And because it's been a taxable benefit, you can receive all that money back tax-free personally. CRA has officially not ruled on it. They have just said, we have no comment. So for now, we are setting it up
continue.
that way.
Yeah.
And they haven't ruled on it.
The corporation and out personally?
No, it would just go to you personally. So that $10,000 that you've paid, let's say for 20 years, so 200 grand would go to you personally, tax-free.
Provided we did that little
Provided we did the
adjustment.
2 grand.
She has to communicate with me.
Yeah, it's got to go.
Gotta fix that.
It's a big one.
Yeah.
It's got to go. Yeah, if you get it audited, that keeps it all clear.
But it's the 2 grand plus the
We're good.
appreciation, right? So you're getting a lot more than the 2 grand.
The return of premium that you would get back? Yeah, the 2 grand is the cost for the return of premium. So you would get back the full 10
Yeah. So
personally.
It's like a great way to like.
Unlock money out of your corporation tax-free, yeah.
Yeah, that's where it's going. And then
Yeah, so it
on the
protects you
personal
while you are building your business and running your business and kids and whatever.
Yeah.
Yeah.
On the personal side, can you speak to the personal side of it? Because on the personal side, if you have critical illness insurance, say
Yeah.
you don't get sick,
Yeah, you can still do return of premium personally.
yeah.
Yep. Yeah. You get it all back personally tax-free. Yeah.
I just remember when that.
It's a nice little lump sum
nice
to get.
little
Yeah.
thing and you're protecting yourself against.
Yeah, while you're working and yeah. Yep.
What other options are there for people that have something that prevents them from getting more life insurance? Like, I have a heart problem. It doesn't affect me, but unfortunately I can't get any more. So what happens then as I grow my business and
Yeah.
my portfolio?
I mean, yours is one we're going to keep arguing, let's be honest. Yeah. Yeah.
Have you seen that adjusted over
So
time? Or?
yes, we do see that the insurance companies do move and allow certain conditions over time, but gosh, they're dinosaurs. It takes a while. What we see is more guaranteed issue products coming online.
What does that mean? What's a guaranteed issue?
Guaranteed
product?
issue basically means that we don't have to go through medical testing or underwriting in
Okay.
order to be able to insure you.
Okay.
So usually the amounts are lower, but over time
The
we can
insurance
chip away
amount?
at it. Yeah.
The coverage.
Like if
yeah.
you were trying for $1 million, you could get 250,000. But over the next few years, you could chip away and get 250,000 every 2 years. So you can add up after a while.
So
Yep.
every time I get a mortgage, is it worth it to, when they offer you insurance, to just take it, just so I can get?
Pre-existing condition, it'll never pay out.
I don't know.
They do post-claim underwriting. Yeah, it'll never pay out. They'll tell you it'll pay out, it won't pay out. No, it's post-claim underwriting. They'll say it's a pre-existing. Yeah. Yeah. So that's a big thing with underwriting with insurance. So you can underwrite pre-claim. So you can underwrite when you get the insurance policy, which means the insurance, they'll draw blood, they'll ask questions, that sort of thing. All of the business that we do is pre-claim underwriting. We want to make sure that it's guaranteed the insurance. Post-claim underwriting, a big example of it is mortgage insurance. So you answer 3 questions when you sign your mortgage, you start paying every month, you don't think about it. You pass away, then the mortgage insurance company goes, okay, let's see how you passed away. Typically people don't pass away from being healthy and having nothing wrong. So typically we see the stat in Canada is 2 to 4% of mortgage insurance is paid out.
Oh, wow.
The stat in Canada for pre-claim underwriting so I have 2023 stats still, was 98.7% of claims were paid out. 1.3 doesn't get paid out versus 96 to 98.
That's interesting.
And you'll always pay more for mortgage insurance than you will for your own policy, always. 18 years in the business, mortgage insurance has never been cheaper. It's always. Because what they're doing is they're saying, every 40-year-old woman in Canada, we're just going to charge you the same. Whether you take care of yourself, whether you're healthy, it doesn't matter. We're going to charge you the same. So the mortgage insurance rates are high and climbing, whereas the pre-claim insurance rates are actually falling. They're actually falling, yeah, which is great. Yeah, insurance is getting cheaper. Amanda's never heard greater words. It's her favorite thing.
I pay you so much insurance.
I mean, in the fairness, it's not to me.
Although Rochelle and I were just discussing the critical illness, we're like, okay, that's gonna be coming up in maybe like 7 to 8 years.
Yeah.
Like, we should just plan a vacation,
Yeah, it's gonna be good.
right?
Where are we going?
Oh, no, you're going to finance.
Disappointed. I was really excited for that one. Yeah. Good.
Yeah. Open it up to questions, maybe.
Yeah. It's 8:15, so if anyone has to leave, don't, feel free, head out, all the things. The one thing we didn't touch on, we can touch on tariffs.
Oh yeah,
It's
that's
good
all
times if people want to hear about it. And we can answer any other questions that anybody wants. Feel free. Bye, Rach. Thanks for coming. Yeah. Yeah.
Tariffs. We have a request for tariffs. In the
Tariffs. They want to
Yeah.
know tariffs. Yeah. Tariffs are really fun these days.
It's not happening, so I wouldn't even.
It was probably not going to happen either way. It's totally fine. Everything's fine. So
Trump's distracted now, he's working on the Gaza Strip, so
he's very busy. Also, I heard he's pissed about our banking, so it's fine. He'll be fine.
it's gonna be like Vegas overseas.
Yeah, it's going to be
So
great.
easy.
It's going to be totally fine. Nobody will be mind.
See you,
Bye,
Mark.
Mark.
Thanks for
See you
coming.
later. Tariffs. Nice to see you. Yeah.
Thanks for coming, guys.
So tariffs. Is there anything specific you want to know, or just go for it?
It's gonna ruin the TSA.
Yeah. We export in Canada somewhere between, I've seen so many figures in the past week, 60 and to 70% to the US. It's a lot. It's a lot. It's very
Is that in dollar or total
dollars.
dollars?
That's dollars.
It's not percentage of our of commodities. that
No,
we-
no. 60 to 70% of our exporting dollars go to the US. I've seen everything. I've seen 62. I saw 70. So I don't know, somewhere in there. The buckets for that, back to the buckets. So you've got 25% energy, oil and gas. 35% is materials, so things we extract from the ground, lumber, steel, aluminum, bit of lithium, copper, all that kind of stuff. Yeah, those kinds of things. 15% is consumer goods, X automobiles. 10% is automobiles. What would get hit first and hardest and fastest is our 10% automobiles, followed by, from the data, it looks like parts of the materials, lumber, steel, would get hit next. Potash, but at the end of the day, he'd probably put an exclusion on that because they need it so much. Energy would be the least hit, and that's why he put 10%. The little nugget kind of there, we send about 4 million barrels a day of heavy crude to the United States of America. Venezuela has the largest supply in the world. They can't, pardon my French, get their shit together.
The Americans have an embargo on Venezuela.
That too. Yeah, small detail. They politically can't get it out. I mean, most of it's offshore. They're not even drilling it, so it's non-issue. Saudi and Iran are, I think, 2 and 4. We're 3, so I think Saudi and Iran are 2 and 4. Look, to get a cargo ship across that takes 45 days. I mean, let's just start there. It's 4 million barrels. Like, what are we doing here? Like, this isn't happening. So he's got to get the heavy crude from us. He really doesn't have an option, which is why it went 10%. What the backstory behind that the economists I read is they anticipate that the US dollar would appreciate a little bit, the Canadian dollar would fall, and really the 10% would become negligible for him. So that's why he put the 10%. The small piece there that could help our Canadian producers, actually, if he happens to do that, there's WTI and WCS. So WTI is typically light sweet crude out of the US. It's very cheap to refine. They have a lot of it. So it's priced wherever it's priced. And the spread between WTI and WCS, which is our heavy crude, Western Canadian Select, somewhere between $12 and $18. If WTI becomes slightly more valuable and we can keep that spread about the same, Western Canadian Select could go up. So it would be nice. Our Canadian producers are typically paid in US dollars and their expenses are in Canadian dollars. So it's really not going to hurt them. Like, that US dollar goes up, the Canadian dollar goes down, they just made more revenue, their expenses got cheaper, things are looking good. So the whole energy thing, I think, is really just kind of going to go out by the wayside. Automobiles isn't good, but if you walk through kind of the process on this, and Trevor Toome actually did a really interesting one on this, Canadian manufacturers buy a lot of their parts from the US, so now that gets more expensive. So then the Canadian manufacturers, it doesn't really get them more expensive to manufacture it, but now they're going to sell them back to the US as finished goods. So they've just bought it at a higher price, so now they're going to pass along that to the US consumer. And now the US consumer...
Fucking each other over is basically what
Exactly.
So does it not just cancel out
So
to some extent?
it actually makes it, from what Trevor said, actually more expensive for the Americans to buy it. So remember who buys trucks? The Midwest, Texas, and Tennessee. God, that's so many Republican states. There's so much Republican in there. Like I was like, okay, well, it's not Connecticut that's buying trucks. So all of that. Also, when he decided to put the tariffs on, I really did like that the stocks that took the hardest hit, the market that took the hardest hit was the NASDAQ, which is the tech market. Remember when he got inaugurated and just the slew of CEOs and owners that were behind him were all from Microsoft and Elon, and their stocks got hit the hardest initially. Probably not good for Trump supporters either. The S&P followed, so did the Dow. The TSX did fall. They all recovered. So all of this tariff talk just feels like a really big distraction by Trump. I mean, look, he did this. There's all kinds of stats. I think I shared this hilarious one with you, Michelle, that apparently this was recorded, and I've really got to dig into this because it's a hilarious stat. 98% of what Trump said was never actually put through from 2016 to 2020.
Oh, wow.
Now, what he said, I need to uncover, but I just thought it was... He just says so much. It's like, is that why? Is it just a volume thing? Like, I don't even know. But so I think we're going to get a lot of this. He, the Gaza Strip, now he's upset because he has no American banks in Canada. Oh, 40 million people. We got enough banks. Yeah, and remember, this whole thing started with tariffs because he's so upset about the trade deficits and he's so upset about border security. Okay, so the stat is less than 1% of illegal drugs in the United States comes from the northern border. How they know that, I don't know. Less than 1%, really. Border security, they're estimating, I've seen lots of numbers, but I keep seeing between 2 and 5% of illegal immigrants come from Canada into the United States. The numbers are substantially larger from elsewhere. So again, and we have to remember the last free trade agreement was put in by Trump and Trudeau in 2020.
He's very angry about that agreement.
He's very upset about it. He designed. Yeah, so NAFTA was 94. 2018, Trump was mad. So he scrapped NAFTA. It got signed in 19. It's called USMCA. It is an agreement between Trudeau, Trump, and the previous Mexican president, enacted July 1st, 2020. Okay? He now in 2024 started announcing that he was very upset with the trade agreement that he put into place. So, I mean, I don't. Would it hit our economy? If it actually went through, the numbers I saw were pretty steady that our GDP would fall by 6%, inflation would go from 2 to 5. So would it be really bad? It would be really bad. There's really no escaping it. It would be really bad. But I actually, one, I don't think it'll go through. And two, I really think that this gives us the opportunity to, one, increase interprovincial trade, and two, for us to export to other people besides the United States of America. So I think it's a bit of a kick in the butt for Canada to get their SHIT sorted, like really at the end of the day. What Trump is taking advantage of is a really bad political system and like situation in Canada. So he didn't cause it. Canada caused it to themselves. Right. He's taking advantage of it. Probably not the nicest thing to do, but also he didn't cause what is happening. He wouldn't be able to do this if we didn't trade 60 to 70% of our exports with the US, and if we didn't have the horrible interprovincial trading that we have.
That's why Canada signed NAFTA in the first place. More to fix our interprovincial trade than to
Yeah.
trade with the US.
Yeah. So I think if this pushes Canada to trade with other countries, if this pushes Canada to drop some of the interprovincial barriers that exist that are frankly so ridiculous, some of them, you know, this could be a great thing for Canada in the long term. Yeah.
Wake up call.
Yeah. Great wake up call.
Yeah.
Yeah. Yeah. So that's what I say on tariffs.
Thank you.
Yeah, you're welcome.
Yeah,
Good
I
stuff.
like that.
Good stuff.
Yeah, thanks.
Thanks. We kept everyone really late, but good questions and stuff.